It's always a good time to buy a house, buy a rental property. Not always for a homeowner, but as an investor, I'm looking for the best deal in my local market to hold long term,
Yeah.
regardless if prices come up or down a little bit over the next couple of years. So whatever prices are, whatever the rates are, find a good deal for today. And if it gets
Yep.
better, great.
Alrighty, folks. According to Redfin, home prices have crashed. Oh, no, wait. It's opposite day. Home prices are up 6.2%. They are now at a new record high of 434,000. The previous record high was 433,000. Anna, we got to talk about home prices. Can it continue? What the heck is going on? This is pretty wild. Record high with 7% interest rates. Wow.
Yeah, I always look at headlines and I say, okay, so what does that mean for me? What's happening in my local market? Because as we talk about, real estate is really at least regional and pretty local. So the national headlines may or may not be the same for you. And I say that only because, yes, we have record high prices in some markets. There are other markets that were the leading markets a few years ago that are actually down 10 to 15%, which is
For
in
sure.
correction territory. So talk to Austin, Texas, and see if they would be excited about prices going higher. They wouldn't. And I love Austin. I'm actually speaking at an event in 2 weeks in Austin. I've looked to buy in Austin, but nothing made sense. And when you get to a place where nothing cash flows and credit dries up and rates go up, values are going to fall because there's just too much supply and not enough demand. Other markets, maybe more like the average market and my market, continue to go up in value. And it's really all about supply and demand again. Why are prices up? Because there's no supply. People are locked in, wanting to or not wanting to move. They've got 2 to 3% mortgages, a lot of them. Some of them still 3 to 4%. That's like up to 4%, I think is like 80%
Yeah.
ballpark of homeowners. So when you have a lack of supply, your prices are going to keep going up if there's still people that want to buy houses. So right now in most major markets, there's still a little more demand on the sidelines than there is supply. And that's why. So can it continue? Yes, it can. Do I think it will? No, I don't. I think if rates start to fall, which the Fed will start to cut rates as we have more of a softening economy, when rates fall, initially you're going to have a lot more people wanting to buy and a lot more people willing to sell. The question is, how long does it take for supply to tick up equal to demand and for there to be an equilibrium again? Right now, there's still such a lock-in effect to that lack of supply that I think initially when rates go down, you're going to have bidding wars again because there's still
Yeah.
not a lot of supply. If you get to really low rates, and we had a deep recession, Michael, and rates really fell and the Fed had to drastically lower them again, then people can say, okay, I can give up my 3 for a 3.5 or 4. And then
Right.
you might have a ton of supply. And that could actually bring prices down if there's, less demand than there is supply. So nobody really has a crystal ball and can really tell you where it's going to go. But I think that this trend of continuing to go up in price over the long term, I think there might be softening still to come in some markets.
Mhm.
Well, especially if there's a recession. So we'll see.
Yeah. I think it's really, really interesting when you kind of play that interest rate game out because I agree with you. And I don't know that I've put this on video. I think if rates come in, let's put some numbers on it. Let's call today 7%. If rates come in to like 6.5, I think that just unlocks marginal demand. I don't think supply moves all that much, if at all.
No.
However, you get rates sub 5%, certainly, without question, certainly below 4.5, you could actually unlock a bunch of supply, and that unlock could actually dent prices. That's the wild thing, right? Rates come in a
Right.
little bit, prices, demand goes up, likely prices. But if
Right.
you really have a bad recession and you whack rates to, let's call it 4%, that is really weird. You're right, because a lot of supply could come on at the same time. You could unlock the move up buyer, which has basically been out of the market for 3 years. It's wild to think about a 4% mortgage rate could hurt prices.
It really is. And especially because if you have a 4% mortgage rate again, it's because you're in recession. So
Exact. A
it's
bad one.
not going to happen until we've had a recession. And so as the consumer, this is where I'm always coming back to what's happening to the consumer. And that can vary across different markets, different regions, different price points of a home. The average consumer, the average living check to check, the best stat that I've seen is 66% and ticking up, is living check to check, has $1,000 saved, like we talked about last week, and has max credit cards. So it's going to be hard for that average to qualify for a mortgage. So if they're stepping down in their payment, meaning they're downsizing, or they're already in a higher rate home and they're trying to find something cheaper, they might be qualified for that loan. But if they're already tapped out and they're not going to be that move out buyer. I think, Michael, there's going to be less move up buyers because I think that in a recession, after people have gone through COVID and then inflation rising their cost of living average 24% over the last 3 to 4 years, I think they're going to be more cautious about that move up, even if they have a low interest rate. Now we have a very bifurcated economy. That word is really a good definition of our economy, where those that have a higher income and really secure jobs, they probably will still move up and trade that low interest rate for a nicer home at another low interest rate. But I think the average homeowner might stay put if they're worried about losing their job, or they don't think that they can relocate or afford a more expensive house. And when they start seeing the news that there's layoffs after layoffs after layoffs. So I think, and nobody's really talking about this because it's not a data point, but I think given the psyche of the consumer and how rocked they are over the instability and the change that's constant over the last couple of years, I think there's going to be more fear in the consumer, and I think less people move because they're afraid to move. And that could keep demand a little lower, even with lower interest rates. If you have a lot of supply of people trying to move, not as much demand of people wanting to move, that could cause some softening in home prices. So it just is going to depend on the market that you're in, and how much supply comes online versus how many people are willing to move at that time and able to qualify for a mortgage.
No, I think it's a wild conversation to kind of play the chessboard out. And you're absolutely right. Real estate's very local. We talk about buy boxes, on this channel. Everybody should have their buy box, watching active listings, watching price drops, watching pendings. Everybody should be doing that for their buy box. But when we look national, um, it is really weird to think about going to 6.5 probably means prices go up, but going to 4.5 probably means prices go down. I mean, I don't know that I would have said that a year ago.
Yeah.
And,
And
and,
I do think even now though, like you look at, so I had a property that I bought in the Smoky Mountains. I love the property. It doesn't do quite as well as I hoped it did when I bought it, because we have had some softening and some oversupply there. But I've had the property on the market. I had it on for 6 months and I pulled it because there was too much supply in that market for all the people that way overpaid and have to sell, and there's not enough demand coming in. So especially in short-term rental markets, you're actually seeing these big price cuts. So, when rates come down for those, you might actually have prices come back up because you have people wanting to go back in and buy at lower
Mhm.
prices and lower rates. They cash flow again on these investment, these vacation rentals. So your prices could actually come back up in those markets that are down, but start coming down in markets that are up. So it really all comes down to supply and demand. And over a short period of time, it's hard to guess where that's going to be. Over a long period of time, a few years through a recovery, I think you come back into balance where you have a buyer and seller market where, as rates settle wherever they're going to settle after a recession,
Mhm.
it's kind of going to become the new normal. People are going to get used to it. It might take a couple of years, but I think you come back to more of an equal market. But I think that could take, 3 or 4 more years, Michael, before we really know what's the new equilibrium, unfortunately.
Yeah.
Do you
I'm
agree, or
curious.
you think that's too long?
Um, to get an equilibrium on rates. Is that the
On
question?
just an equal buyer seller market, just not a buyer's market, not a seller's. Like you go through recession, maybe a year, you have 2 years of recovery, then the Fed brings rates up to where they're going to be post recovery, the next round of QE. And I think
Yeah.
that's when you kind of start seeing a new, people know what the real new interest rate neutral is going to be.
Right. Yeah.
It's going to affect investors probably more in their decisions about buying and selling homes than it is homeowners. But it's all that to say that I think we're going to be in a artificial economy
Yeah.
still over the next couple of years.
For
That's going
sure.
to make it really hard to tell and to make a guess, are we going to be in a buyer's or seller's market? So the so what for me though, Michael, is it's always a good time to buy a house, buy a rental property. Not always for a homeowner, but as an investor, I'm looking for the best deal in my local market to hold long term,
Yeah.
regardless if prices come up or down a little bit over the next couple of years. So whatever prices are, whatever the rates are, find a good deal for today. And if it gets
Yep.
better, great. Just don't buy in an area that you think, there's going to be way more supply and that's going to drive down prices.
Yeah. I was actually interviewed by Mike Simonson at Altos Research. I think that was last week. And we actually talked about transactions a little bit. Because as we all know, transactions have been, that's where the crash happened. It wasn't price, it was transactions. And you and I've also talked about the 54-year spreadsheet. I don't see transactions going over 5 million in existing home sales for 4 or 5 years, right? It's
Yeah.
just the Fed broke the housing market. It's broken, and the only fix is time.
For sure. And, part of the complexity of this is that in many markets, I'm just going to play the national. Now I'm going to go wider, right? Nationally, we skipped the hyper supply phase of the real estate market. So
Mhm.
when you have a real estate economy, you usually have recession and then you have a recovery and then you start to have building and then you have a lot of supply. And then suddenly you get too much supply and that makes real estate values start to fall because there's too much supply, not enough demand makes prices fall. But we had an economy that reached a peak and it started to contract. But in many markets, we didn't have real estate hyper supply. So when you don't have enough supply for the people that want to move at those really low interest rates that we had, it just kind of breaks the market. And so we have this decline in the economy without hyper supply in real estate. That's not a normal phenomenon. That's an artificial phenomenon that's happened as a result of COVID and then the post-COVID stimulus that created the inflation, when otherwise, real estate supply and demand wasn't that unbalanced before. So it's hard to know what's going to happen with supply and demand when supply was not oversupplied. In fact, in many markets, it's still undersupplied, but we've got this lock-in effect of what the Fed did with raise rates that says supply could stay low for years. Like if
Years.
I mean, Michael, my interest rate, I think on my home, and I have a few under 3, but I think my primary is 2.6%. And someone just asked me the other day if I would move. I'm like, I'm never moving.
Yeah, I'm
I'm
not
never
going
going to see
anywhere.
2.6 again, ever. I don't think I'll
Yeah.
ever see it. So why
Yeah.
would I move? So I'm going to be the one that's locked in by choice because I like my low payment and I'd have to
Mhm.
trade down to a cheaper house at a higher rate to get that.
Yeah.
So yeah, I think it's going to be a few years to really get back to a normal market, normal supply, normal demand that's not manipulated by what the Fed is doing to monetary policy.
I love that. I love that. Again, folks, having a conversation with Anna Kelly, part of the school community. Video number 3, we're actually going to go to questions from the audience. So if you are watching this and you want to ask a question of Anna or I, put it in the chat. We already have a few from Mark that we will go through first, but there's some other folks watching. So put your questions in chat. We will get to that in video number 3. Anna, where can people find you?
Great. You can find me here on your channel, on social media at Anna Kelly, REI Mom. And if you're looking for real estate coaching, consulting, and deal review advice, you can find me at annakelly.com.
Thank you so much.